Good evening, everyone. Hope I am audible. Am I audible?
Yes, sir.
Okay, right. Good evening. We'll start. So, we were discussing about investment risk, if you can remember. So, there I have discussed different types of investment risk. So, currency risk, interest rate risk, issuer risk, equity risk, commodity risk, property risk, and finally liquidity risk. So I have discussed all of them the other day, so I will not take time to go through it again. So we stopped at liquidity. This is where we stopped. So we need to continue from there. Now, when you look at this, when you talk about the risk, there are when you talk about risk, that is about the volatility, right? Risk is about volatility. That means the level to which the return is fluctuating, or the benefit, whatever you call it, whatever you expect, right? To what level it is fluctuating. So that is what we call the volatility. So the volatility is measured or quantified using a dispersion measure we discussed in the previous topic, right? The variance we discussed, and then the square root of variance we discussed as what we call standard deviation. Standard deviation is a measure of risk or measure of volatility. A low standard deviation implies low risk, and high standard deviation implies high risk. That's how it works. Now, when you want to calculate risk, remember risk is about future, right? Risk is about future. So uncertainty in future, we look at, right? Now, the problem is when we evaluate the future, we cannot use futuristic data because that's not available. I think you estimates. So what we can do is, as an approximation for future information or the values, you can use past data. However, when you use historical data to estimate the future, there is an underlying assumption that the future will follow the history. That means whatever the fluctuation you witnessed in the past will continue in the future as well. That's the assumption you have when you do this. That could be a correct assumption. No, it could be wrong if the circumstances or the factors that led to the historical movement is likely to change. But that's what you can do. So here's an example. An investment has an average annual return of 9% and a standard deviation of 4%. So what you can expect if you make an investment on the same instrument or a similar instrument. There's a chance of 2/3 that the annual return will be between 5 and 13. So how did we take it? How did we take it? Can someone tell me, how did we take this 2/3 story? Right? What's the basis? Anyone remember?
66% of the normal distribution, we use that standard deviation.
Yes. So you're looking at the normal distribution we discussed, right? Remember, in the normal distribution, if the data is following a normal distribution curve, we discussed 66% of the data will be within one standard deviation from the mean. So here we can consider 9% as the mean or the return, and 4% is the standard deviation. So within one standard deviation mean plus and minus, right? Plus and minus. That is, you look at standard deviation. Right. Something wrong with the drawing pad. Let me see. Right. Normal distribution, then you have something like this. Right. So the midpoint is 9. Then left and right, right? So one standard deviation, one standard minus, plus 4% each. Right? 9 minus 4% is 5. 9 plus 4% is 30. So between this area, you have 66% of the data. So that's the mechanism. So if you go one step further, 2 standard deviation, that is 9 plus 8, that is 17 here and 1 here. So between these two, you have 95%. Right? That is based on this normal distribution we discussed. So the other side of the story, when you look at when the 2/3 is within this range, that means there is a 1/3 chance that the return will be outside this range, because 2/3 the chance is there for it to be within the range, and therefore it suggests there's a 1/3 chance or 33% chance that the return will be outside this range. Right? The volatility of a share or a fund can be compared with a benchmark or a standard, which is performance can be compared. You can compare your performance when you want to benchmark. You can compare it with the standard. So the standard could be FST 100 in this, right? So that means a share funds like in Sri Lanka, we used to have something called Milanka or some elite shares in a group, high performing shares in a group. That's a separate group. Likewise, in the UK setup, FST 100 is the index of blue chip companies listed. So you can use that kind of a benchmark to measure the performance against those. So a benchmark, what is a benchmark? Benchmark for any purpose is a standard you use to compare, right? So benchmark could be for your performance, it could be for anything. It could be financial performance, it could be individual performance, right? It could be a quality level. So whatever, you can use something as a standard so that you can compare yourself or your case against that benchmark. That's the idea. So when you evaluate a fund, right? Typically in a fund means you have a pool of investment, and then from that pool you invest in separate shares or individual shares or different markets as a portfolio. So when you operate a fund, the performance can be compared with a peer group. It is comparable. Your fund should be compared with a group which has similar features. Or market index. Market index like FST 100. So that gives you the performance standard. Sometimes for certain types of funds, right, depending on the nature of the portfolio, a standard such as a return on a particular government stock or the risk-free. Right? Now, here, remember, when you use, let's say you don't have a similar private sector or another portfolio or benchmark with similar risk profile, then you can use a government stock or a portfolio. However, when you use a government portfolio, we know as a fact that the government securities have lower risk than a non-governmental securities or investment options. Therefore, it may not be appropriate to blindly compare the performance of a government bond against a other instrument. So what it says is, when you don't have similar private sector and government portfolio to compare, you can use the government investment options or government instrument, but you have to adjust it, right? So there, your benchmark would be not just the government bond as it is. You need to have a benchmark several percentage above the government bond performance so that you set a reasonable benchmark for you to compare. That's what it says, right? Should be several percentage up. Right. Then the beta factor. I think I explained this previously also, what beta is. Right. So what we do here is that when you compare your performance, it should not only be in terms of the return. So you can compare your return with the return of another portfolio government, but with an adjustment. So that's about the return side of it. You must also compare the risk side of it, right? Whether you achieve that return at a reasonable risk. So for that, you can use beta factor. So beta, what it does is, I think we've discussed previously. Beta is a factor to identify the volatility of an instrument against the market volatility. So you get the market volatility or the risk ascertained, and then you multiply that by the beta factor to get the securities volatility. So if the beta is 1, the factor is 1, that indicates your securities risk or volatility moves in line with the market or the benchmark. If the, let's say, if the market return increases by 10% for whatever the reason, this says if the beta is also 1, the securities will also increase by the same amount. So the volatility movement will be the same for the security if the beta factor is 1. If the beta factor is more than 1, that indicates the volatility of the security is greater than that of the market, right? The volatility is very high against the market. And the other way around, if the beta factor is less than 1, the fluctuation in the security is less than the fluctuation of the market. That's the idea. So that way you can use beta factor to benchmark the movement of the security or the risk. And then there are a few other ratios we generally use in managing risk and performance of funds and portfolios. Alpha. So alpha refers to the extent of any outperformance against its benchmark. That means the outperformance of the security against the benchmark. Benchmark could be anything as we discussed. If the security is performing well, that outperformance against the benchmark is called alpha. Then the Sharpe ratio, you are comparing the return of a portfolio against a similar risk-free rate. And that means the performance of the portfolio against a risk-free rate is what? So that means that will give you an indication about for each additional risk assumed by the portfolio, how far your return is on it. That means if you have additional risk that you assume, your return should also go up to maintain the gap. Now, if the Sharpe ratio is high, that indicates risk-adjusted performance of the portfolio. And that is taken into account. And greater the implied level of active management skill. That's fine. Then this is the formula you use to calculate the Sharpe ratio. Return on portfolio minus risk-free return. So this part will give you the excess return, right? Excess return. And then you divide it by the standard deviation. That's the risk measure, right? So then per unit of risk, how much is your return? That is what we try to establish with this. Then there's another one called the information ratio. So the information ratio, remember, so these things are important. So you have to know the differences among these, because at the exam you get different questions on this, right? What it means and how to calculate. So the information ratio, it compares the excess return achieved by a fund or benchmark. So you get the excess over the benchmark, whatever the benchmark you choose. To its tracking error. What is tracking error? So here you can see what's tracking error. Tracking error here is the standard deviation of return related to the benchmark. Right? This is a relative standing. Right? So excess return against the benchmark and the standard deviation against the benchmark, or the risk against the benchmark. That's what we call the tracking error. Now, this ratio will tell you how closely the portfolio follows the benchmark, right? Follows the index, so whatever it benchmark. Especially when you manage the performance of fund managers, we use this ratio. Because it tells you how effectively you manage the funds. Here's the formula. Mean of excess returns. You get the excess returns and then get the mean or average. Then you calculate the standard deviation of the excess return. Then you will get revenue per unit of risk. And that is what we call information ratio. So in addition to major items in the balance sheet that brings investment is there are other features you need to look at. When we look at an organization, you have asset classes. But it's very important. When you say asset classes, different categories of assets. So you need to understand the risk profile embedded in each class. That's a given, right? However you manage it, to operate it, the risk connected to different asset class, you need to look at separate. So then when we have venture capital, private equity, property, I'll take one by one. Venture capital. You must have heard of this term. Venture capital, by definition, has some salient features. Right? It's a type of private equity capital. That means individuals, high net worth parties, you provide funding for high potential early stage growth companies. So their idea is they will be part of the investment at the early stage, and then you can milk or get the benefit later when the business start forming. That's the idea. And mostly these investment, they come in terms of share investment, right? You pay cash and get investment. Now, according to this book, you can see the venture capital investments offer three main advantages, especially for a portfolio. One is tax advantage. So it depends on jurisdiction. Like the country to country, things can change. The tax advantages are there depending on how the tax structure is designed and the benefit you can derive from this kind of investment, depending on the provisions. But not every country, every part will have this depending on the current system. And then the potential for high returns, that is there because venture capital by definition is something that someone invests in high yielding investment. So the investment or the return has to be above the norm, right? It has to be much higher. And that is there possible because it has its own risk, and as a result, it's possible to have this. And when you have a venture capital investment, the correlation, because venture capital investments are exclusive type of investments. So other investments could be a typical investment drive, right? Now, when you have venture capital investment within the investment portfolio, there's no interconnection or the correlation, which sometimes help to minimize the volatility because when one party is volatile, the other will not because it has a sound, it has a different return risk profile. So it will help you to have overall better a portfolio because there is a mix or diversity in the investment portfolio. So then we look at private equity. So private equity by, the definition, as the definition says. Here what happens is the companies sourcing equity or obtaining funds on a private basis without going through a market, stock exchange, right? Without going through that process, privately you acquire. Now, when you do this, you can do it in different ways. One is the investor can get the company issue more shares and then pump that money into the business so that you become a shareholder and the money will come to the business. That's one. Other one, you can acquire the company through shares. It means existing shareholders will sell their stake and the new shareholder will acquire it. So that's a transaction. Now, when you have a private equity investment, there is a possibility. So what it says is, you can have a portfolio of private equity in you can mix it with standard portfolio. Then naturally you have a less correlation, because when you have a less correlation, that helps you to have less impact. Right? If you have a positive correlation between the two, the movement will be both. So that's why you have to have a portfolio. We discussed when we design the portfolio, the parties should not be perfectly correlated. Then both will move in the same direction. It should be other way. Then the property. And property generally we take as physical. Right? And these properties generally bring long-term returns, not like inventory. Now, when you have different investment options, having a property in your portfolio gives you a consideration. Sorry, can give you a diversification benefit, because then you have a mix of investments. You can have instruments, right, intangibles in your portfolio, and then on top of it, if you have property also, so that you can take as a total mix, and that will give you a better portfolio risk return proposition than having it in isolation. However, the challenge with properties, unlike other securities, is it is a physical thing and it can get affected with the market moves, and it can even lead to prolonged downturn. So we are experiencing to a certain extent these funds in the property market in Sri Lanka as well, right? Then, for a period, it keeps on coming down unaffected. Then we have a concept called responsible investment. This means when you work on your financial gains or targets, to what extent we consider the rest of the variables, especially the social, environmental, social, and governance aspect. Because that when you make an investment, if you pay attention to those things, that is called responsible investment. Because you are not looking at one angle, you are looking at the holistic thing. Why should we focus on these things, especially ESG? This keep evolving. So environmental concerns, depletion of resources is becoming extremely challenging in every industry. If you do not preserve the environment, you may not be able to sustain as a business. Even if you're safe in the short run, in the long run, you will have repercussions. Then have social concerns. Now, this can go into a broad area, right? Because the customer demographics change, tastes change, and your interactions change. And how far you pay attention to the human rights and welfare. So when an investment is made, to what extent an organization pays attention to these areas, that is being responsible. Then corporate governance concern. Right? Now this corporate governance, it is a broad area. We also have a separate topic to discuss later on corporate governance. We'll touch on it. It spans to many areas. Right? The roles and responsibilities of the management, the structure, the transparency, various policies and procedures. This will also increase the credibility of the organization and the value. Right? How many of you know CalPERS? Have you heard of this term? CalPERS? CalPERS. Anyone? CalPERS. So this is the extended full name of CalPERS is California Public Employees Retirement Scheme System. California Public Employees Retirement Scheme. It's like the pension fund here in Sri Lanka. Like the pension fund, right? So that's the fund that manages the pension of the employees. Now, this institution, I haven't dealt with this recently, but some time ago I used to study this because there was an interesting concept there. So what they say is this particular institution has a very high standard of governance. Right? Whenever they go and invest in another company, they make sure that those organizations adhere to the governance standards at the highest level. As a result, there is a public perception whenever CalPERS involves with any company, naturally the governance of that company will improve. So there was a public perception because of the way CalPERS operates. And that not only gives an advantage to CalPERS to have more confidence in them by the general public, but also it helps the target company when CalPERS goes and acquire other companies. It helps the target companies to increase their share prices as well. Because when people know that a company like, or an organization like CalPERS has got involved in this business, and now you can expect something good. You can expect better governance in this organization, but that's how CalPERS work. So see how these things can can be addressed, and how an emphasis on governance can pay you off, right? That's part of responsible investment. You take care of those aspects as well. Right, now we have a look at correlation of performance between asset classes. So you can have different I told you earlier there are asset classes, right? And then you see the correlation in the performance. Now, when you have asset classes, how they interact each other, how one is affecting the other is about correlation. But this changed over time, right? Because the asset allocation has to happen, which is at a higher level. You identify assets or the pools or investments and park it in separate areas based on the appetites, right? And how much you're going to invest in what areas. That's the allocation part. You take this into account in that. Right. So what it says is when an organization wants to get rid of some investments, right, do that by looking at the mix of the assets, because you need to have a predefined mix of assets, different types of assets that will take care of different aspects of the organization, not just assets. That's why it is designed that. Tracking error I explained earlier also when I discussed the previous ratio. So this says how closely the portfolio follows the benchmark. So when you have a portfolio, you measure certain parameters to take the performance of the portfolio, right? And then you use that tracking error to predict or forecast the portfolio situation. In that, you can either use a historical data and then extrapolate, as I told you earlier, or you can predict. You can predict based on analysis what is the likely. Right. So now we come to a thing called investment mandate. Whenever you make an investment in an organization, you need an investment mandate. So investment mandate is important for various reasons. I'll talk to you about it in a while. That's important. So when you have a fund or an investment portfolio, generally there are several parties involved in it. So there is a party that manages the fund, right? When you say manages, it could be individuals, it could be a company, right? Mostly a company, management company. And then you have to decide and declare when you invite the investors what type of a fund you are going to invest and what's the aim of doing it. What are you going to get at? And also the limits, if you have, when we do this investment, certain limitations that you want to impose. And also, whenever you have any investment, you have to follow the investment policy, because that gives you guidelines to implement. Now here you can see in a mandate what we get, right? What's the support we get? As I told you, you will have the purpose or the aim of the fund so that the investors will evaluate it and decide whether that is something that they want to engage. Right? Whether they want to invest in that fund or not. That's what they have to look at. And here, that aim will define how you operate the fund and how you reward the investors. So the aim could be generation of a particular line of income, or you can even have something in the long run, not just the short term. And you also talk about specific strategies the managers intend to deploy in managing these funds. And if you look at a larger investment fund, they will not stick to a particular area or a portfolio. They will invest in many markets, so broader scope. And then you need to also highlight the geographical regions. So, right. This fund manager is intending to invest or make your presence. And the sectors where you are going to invest and the type of securities. Yes, what's the security or collateral? Right. Whether the fund is allowed to short sell and whether it will be hedged. Okay. Tell me, how many of you know what is short selling? What is short selling? How many of you know? You can raise your hand or use the text box and you can even talk. What is short selling? Any idea? What do you mean by short selling? No one knows? Right. Short selling is your ability to sell an asset and buy. So you generally buy and sell assets, right? You generally buy and sell things. Now short selling means you can sell and buy, right? You can first sell and then do the buy transaction. So is that possible? In a typical commodity market, that sounds very weird. But in an investment market, especially when you deal with financial instruments, short selling is a common phenomenon. So what it does is, let's say the today John Keel's share price is 200, and I can see a possibility of declining market. So 200 is today's price, but in 1 week's time it can be 180. So what I can do is, if the stock market I'm operating allows me to short sell, I will first sell the 200. I first sell some shares at 200. Right, I'll look for buyers, and there may be people who want to buy it at 200, and then your settlement comes a little later. So I will sell the shares at 200 and then agree to deliver it maybe at a later point. Then I go and buy the shares in 2 days' time at a lower price, maybe 190, right? And then you gain out of it. So what you do is you play with the price movements. You first do the selling to a party and then you buy it at a lower cost later. Timing wise, it happens later, but you do it. That is called short selling. Now, the short selling can be done only if that particular market or the stock exchange permits it. Right? I don't think Sri Lankan context it's permitted in the stock market. Right? There are certain markets that is permitted. That's why in the even the mandate you have to mention clearly, right? Clearly whether the short selling is allowed or not. Then the investor knows whether it's possible or not because it's there in the mandate. And you can also mention whether it's hedged or not. Right. You can also talk about what are your motives, right? Whether you want to beat something or a benchmark with this, you can mention all that so that the reader will understand fully. And you can also mention any investment restrictions. So that will build confidence in the investors. Let's say you have a fund and people can contribute towards this. Now imagine the investor has a doubt about the reckless investment decisions by the investment manager, or the investment manager goes and invest in areas that are not desirable. So then when you have this kind of a provision in your mandate which says whether there are any restrictions, right? Whether there are any restrictions you have already identified when making investment. So that's a good point for the investors, because then there you kind of lock it, right? You lock it and you know what are the areas the funds of this portfolio, so this investment can get into, and then you can decide whether that is comfortable for you. Right. Now we talk about investment portfolio risk. How you mitigate? And there are two types of risk in a broader sense, right? Systematic and non-systematic. And then there's optimization and diversification. Then we have portfolio hedging. Right? We have short selling, I explained you earlier. So these are techniques we use. I'll take one by one. Risk transfer. Now, systematic and non-systematic risk is a terminology we need to understand. Systematic risk is what we call undiversifiable. That risk is not diversifiable. By creating a portfolio, you can't get rid of that risk. Right? So systemic risk comes from factors that affects the whole market. Right? If everyone is facing the risk, that is called systematic risk, because by creating a portfolio, you can't get away with it. Now, for example, look at the Sri Lankan context today. If you take the political risk, right? Political risk is a systematic risk. Why? Because by diversifying your portfolio, right, you have not taken out the impact of political risk. That means even if you diversify, you still have to face the same political risk. Therefore, the diversification will not eliminate the political risk. It will remain. Then there is a portion of risk that can be diversified. Right? That is called non-systematic risk. Right? Systematic and non-systematic risks are undiversifiable. Sorry, diversifiable. Because when you say unsystematic, that means it doesn't affect the system as a whole. Therefore, you can diversify. So that means those risks are unique to a particular area. Right? Let's say you have a risk of weather related risk, right? So when the weather changes, there is a risk to your portfolio because you have invested in agriculture related portfolio. And you have a risk of weather patterns to this. But that can be diversified or reduced by investing in other areas, non-agri portfolios. You invest in technology, you invest in other portfolios. So what happens is when you invest in non-agri area, the risk that you first faced in the agri will get vanished. That's why it says this part of the risk is called non-systematic because it doesn't affect the entire system as a whole, and it can be diversified by creating a portfolio. I think we discuss optimization, right? What optimization means. I think it was last week or the week before I discussed it. I spoke about mean variance optimization, right? Mean variance optimization. How you get the highest return for a given risk profile or lowest risk for a given return. So that's where we identify the mean variance optimization, and that will give you the best option. We discussed that using the graph as well, right? The efficient frontier I showed you. Then diversification. What diversification does is you're helping the investor or the party who is holding it to reduce the risk by investing in other areas. Right? So I told you, if you can recall, just by having a portfolio assets, you can't get the diversification effect. Right? So diversification effect can only come when the options have a correlation other than perfect positive. So if you have a perfect positive correlation, that means both variables will move in the same direction for same reasons. you cannot create a portfolio. But for you to get the portfolio, you need to have either negatively correlated ones or a weak correlation, less than one correlation. Right. Then we have portfolio hedging. Right? You must have heard of this before. In hedging, what we do, in order to reduce the risk, you go and have a position, you take an offsetting position in another area so that the damage you are going to face in one will be addressed or mitigated through another instrument. So your net loss will probably be zero because you are mitigating the two. So when you do hedging, the main financial instruments used are derivatives. What are derivatives? I think I clarified this some time ago, I believe, right? Derivatives. So derivatives are instruments that has an underlying asset but has separate or independent existence. So it helps to manage the risk of investments. That's why I say, for example, when you have derivatives like futures and options, so what happens with options? Options give you the ability to execute your authority within a given parameter. Right. So what happens is, let's say if you have options to sell, you are eligible to sell shares. If you have option to buy, you can buy shares. But how you use it, sometimes if the price movement is in your favor, you don't even need to use the option, right? So it depends on situation, because the advantage of an option is it's not mandatory for you to execute it. It's your choice. If things are good, you don't need to execute it. But if things are bad, you will execute the option and realize it so that your loss on the instrument will be mitigated through that. Right. And when you use hedging as a tool or an instrument to mitigate, you must also look at the risk versus cost, right? What is the risk we are trying to mitigate or address? And how much does it cost for me to mitigate this risk? Sometimes the cost of mitigating the risk could be significant. And then probably some organization might decide, let me not risk it, right? We will not address this risk because addressing it is even costlier. So it's a decision by the management to see which way you want to move. Short selling, I explained you earlier, right? You can sell a security that you don't own because you can buy it later and submit to the party whoever wants it. So that's the beauty of short selling. But it has to be used very carefully and strategically, because especially in our part of the world, we don't have that option because it's restricted. But those who are actually using, you need to be very mindful because the market movement can be totally different than what you plan. Because here there's an expectation that the buying. So when you sell something, right, you believe that that's a market for me to buy it as well to get the benefit out of it. But it may not happen if the market doesn't move. That's why it says some countries' financial regulators have banned short selling in their markets. Even in Sri Lankan context, short selling is not allowed. Right. Let's move risk transfer. Another mitigating option. So you can transfer the risk to another party using different options. Right? To approach. You can take the protection like CDS, credit default swap. Or maybe another asset. So there you might have an assumption that the risk profile of this asset might be different than what we currently hold. So then you transit. And also, when we have a investment portfolio, you need to monitor, manage, and report about your portfolio. So that is the key when we manage a portfolio. This is part of governance. You have to do that. Now, when you do this, there are areas the portfolio will benefit when you handle it properly. That is the monitoring part, management part, and the reporting part. Now, when you do this monitoring and managing, reviewing, you can do different levels. So here are some hints here. Peer review with other fund managers, the same fund. That's very easy. You can you a round of calls sometimes, so maybe some information are probably available, right? So within the same firm, you can have different managers working on funds, and you can compare, right, with other managers how they do. There's something for you to do. And risk review with independent risk managers in the firm, right? Risk review. Now the practicality of the second part, independent risk management managers, right? To what extent you need competent staff there, otherwise you fail. And monitoring for mandate compliance, that's also monitoring. So I told you at the beginning, before you start a fund, you need to have something called mandatory compliance. That is mandate. So when you have an investment portfolio, you issue a mandate for the potential investors. In the mandate, you have what you're going to do and how you're going to manage your portfolio. Then you have to monitor, right, whether the actual operation is in line with the mandate. Then performance attribution reporting, right? Performance attribution reporting. So what do you mean by attribution? So here, what happens is, when you report, the investors or the parties involved for them to understand it better. That's so the contribution. So when you have the performance, your performance is a result of starting with asset allocation, identified, and then the stocks selection and the currency impact effect. Right? That's what we generally look at. Attributes that I have already explained each of these areas. Right, I think that's the end of this particular topic. Anyway, we are getting back to this when we discuss the revision, right? Any questions or clarification you have on this topic or any slide that I have done? Any clarification on investment risk? Right. If you don't have any questions, what I suggest is we'll take a quick break, right? Not a long break like we take generally, because I'm also operating from an outside location. So I'm planning to stop the class little earlier than usual time. So I will recover that to the break. Right, let's not take a long break. We'll take a very short, maybe 5 minutes break, right? Then after that, we'll come back so that we can continue for the rest. I'll go with the next presentation after the break. Yeah, we'll take 5 minute break. Now, next topic is lesson 7. Lesson 7, that is on liquid risk. As you can see, there is a weightage of 10% for this topic. Before we talk about the risk, it's important to understand what is liquidity. So that concept drives what affects this, what affects liquidity, and then you can define where the risk is. As you can see, this definition might be a little broader than what we have learned before. Generally, in our early days, we consider liquidity as availability of cash. Later, we discussed liquidity as availability of cash and cash equivalent, right? That means cash or something similar to cash, so something close to cash, maybe short-term investment. But when you look at this one, you can see this is a broader definition. It is about availability of access to or convertibility into cash. So this gives you a different feeling in terms of liquidity. It doesn't mean that you need to have cash with you all the time. The risk is not about you having cash or not, right? The risk is when you are unable to meet the requirement of cash when it is required. When there's depositors or when there's somebody who comes to you asking for the cash, when there is a commitment that you are supposed to settle in cash, when you are unable to make it, that's where the risk is. So you can fulfill that requirement even if you don't have cash at hand at a given point in time, you can fulfill the requirement by having a channel or an option that brings you that required cash when you need it, right? So therefore, as long as you can provide cash when you need it, you are safe in terms of liquidity. That's why it says it is not about having physical cash with you. It's about availability. That is just one part of it. Or you're having access to cash, or your ability to convert something else that you have into cash when it is required. That is liquidity, right? So if that's what it says, right? Even if you don't have, if you can meet it, you're liquid. Now you can see the first one, said to have liquidity if it can easily meet its needs, right? You have access to cash and your convertibility into cash. And when it comes to an asset, it goes beyond, right? The cash, it also the ability to convert. That means the ability to sell that in the market. There's enough buyers and sellers in the market, and there is the right price in the market so that you can convert that into cash without a problem. Then what is liquidity risk? You can read it several times if you want to understand. But you can break it and understand, right? Liquidity risk. The risk that the firm has insufficient cash to meet its cash obligations and will either become insolvent because you are unable to meet the cash obligation, and as a result you either become insolvent or you suffer losses, because see, you suffer losses from borrowing because you don't have cash, and then to fulfill the cash need you might borrow from someone within a shorter period at a higher cost. That cost is unwarranted, right? You borrow at unwarranted cost, unnecessary cost. That is unnecessary. So that loss is a liquidity problem. Or selling asset at below market price. You know what happens, right? When you have a cash need and you don't have anything else, you tend to sell your assets. But if you try to sell your asset in the market at the market rates, it may not be easy because there won't be readily available buyers. The buyers will shop around, they'll bargain. So if you really want cash fast, you may have to sell your asset at a deep discount, right? Below market rate to attract cash. So that means you have to suffer a loss again. You may not be able to get the real market price of the asset. You have to get something lower than the real market price. That is also a loss for you. Or paying contractual penalties. That means if you don't oblige your cash commitments on time as per the contracts, you may be compelled to pay penalties. So some of those contracts have penalties for not meeting the commitments on time. Then you will suffer. So all these outcomes are considered as liquidity risk. And you see, it's little broader than what we learned before, thought before, right? So you will suffer risk if you exposed to any of this, right? Now, the liquidity level of an institution depends on its need for cash, right? Immediate need for cash. How much cash is required and how much cash the institution currently has. So that shows the gap. And to fill that gap, you may have available credit lines, right? When there is a need, you can borrow from some lines. And also, you may have to convert your assets and how easily you can convert your non-cash item into cash. So all these will determine how an institution is managing its liquidity or the availability of cash to meet the requirements. Right. Now, in an organizational setup, so this liquidity risk is connected to many other variables and factors. That is also important for you to understand how it is. The financial controls, like financial statements, cash flow statements. So cash flow statement is the one that captures the cash movement, receipts and payments, right, and the movement. So that will give you indications about where the cash is moving so that the management can take decisions to ensure that the cash is managed properly. And if you don't have proper control within the organization, that might lead to weak controls and loss the track on cash movements. Then the instruments that you deal with that might require cash or that might generate cash. Either way, right? Depends on which way it goes, it will have an impact. The credit risk, right? So credit risk, how it links here, because when there is a credit risk, you are unable to collect the required cash. And then as a result, you will suffer cash shortage. Then the market risk. So market risk is where you're unable to sell your asset in the market and get the right price. Again, you are unable to collect the right amount of cash. Then the operational risk. Right, operational risk means when you don't manage your operational risk, there can be instances of operational risk materialization that might require immediate cash. So here there's an example. You have an outsourced supplier and you have not looked at the replacement or a backup when you need, and due to that weakness, in the event of a sudden disconnect by that supplier, you might need immediate cash to source the required material from another place within a short notice. So that requires immediate cash. So that's how the operational risk will feed into liquidity risk. And the business risk. That is when you have changes in the environment that challenges your business operations. And then your strategy becomes obsolete to meet the changes. Here you can see an example of a withdrawal of a variable tax treatment. So that means this strategy can fail when you face unplanned changes in the market. So the government all of a sudden withdrew a tax concession given to a particular product, and now it is required for you to now pay taxes for that product. So that requires cash. So what are the tools available to identify liquidity risk? So you can see it's a construction of a maturity ladder. analysis of actual and contractual cash receipts. So give me a minute, I have a disturbance. Give me a minute, I'll get back. Right, so tools to identify liquidity risk. So construction of a maturity ladder and analysis of actual and contractual cash. I'll explain it in a while. So maturity ladder is an important tool that we can use, even our organization, which is predominantly used in the financial sector. What we do here is you identify the different assets and liabilities, or the cash coming in and going out for a given period, and you identify different maturities. And here we look at contractual maturities. So contractual maturities mean as per the contractual obligations. Contractual obligations or the commitments you have with different parties. You're supposed to settle certain items at a particular date. For example, if you have a loan commitment to another party and there is a due date as per the contract on a particular date, contractually you are supposed to settle it, whether you pay it or not. So that you have to put it there. And at the same time, say for example, you take deposits, customer deposits, right? When you have a fixed deposit for 3 months, you are contractually liable to settle that or pay the money back to the customer in 3 months' time. At the same time, when it comes to the normal savings account, the contract with the customer is the bank is prepared to give back the money in those savings account whenever the customer wants. That means it's immediate. So the contractually, that money has to be given back immediately. On the other hand, the recovery of debts or loans you have granted, right? There is a contract with the customer where the customer is supposed to settle the loan on a particular date. The customer is supposed to pay an installment on a particular date. So that's the contractual part. But the actual sense, if the customer doesn't pay on time, that's a different story. This maturity ladder is done based on the contractual maturities. Right? So then you need to identify any specific significant items also there when you do this, right? And you can also make certain assumptions based on past experience. Say, for example, the bonus, right? The organization probably declare the bonus at the year end based on after the year end based on the results. That can happen a little later, right? Maybe you don't know earlier, but based on your historical data, you know generally the bank has paid 2 months bonus to the staff in the past on average based on the performance. Now the current year performance is somewhat similar to what happened in the last year. So based on that, you can make an assumption and consider an outflow of an estimated figure as bonus. So likewise, you can make assumptions and put some figures there as well. Now, you need to figure out, with you put it in different buckets, right? 3 months bucket, 3 to 1 year bucket, 1 to 2 year bucket, 2 to 3 year bucket, 3 to 5 year bucket, right? 5 year, more than 5 year bucket. Likewise, you can have different buckets, and then you identify cash coming in and going out in each bucket. Then you'll see the gap in each bucket. So you can see an example here, right? the period. So day 1, day 2, day 3 to day 15, day 16 to day 30. So you define what the buckets are. You can see on the left hand side, cash inflows, right hand side, cash outflows. You can see in each period whether there is an excess or shortage. So that helps the bank or the institution to figure out any shortages or any gaps in each area. If you notice a gap in some period, that gives you a support or a early notice that you're supposed to manage that before it actually happens. Then that means you need to work on your cash inflows and outflows and eliminate the gap when you really reach that period. So you have to have a strategy or mechanism to do that. Right? So you can also add, in addition to your routine cash movements, any excess fund requirements you can bring in, because that is the reality of your business. You can look at if there's a requirement and you can bring that also in. And your overhead. And also you can bring in some future strategic commitments. Right? There are things that you think that is required in future based on your plans. That can also be factors in the right bucket. Right. Then you need to understand, I told you our basis of preparing the maturity ladder is contractual commitments, right? Not the actual cash movement, but the contractual obligation as per paper. That's why, for example, if you take the savings deposit, I told you, generally we put it under the first bucket, but it doesn't mean that all the customers will come and take their money back immediately. So you sometimes see a gap, but that gap is not a realistic gap because it doesn't happen that way. But here, when you do this exercise, that's how we deal with it. Now here you can see we are going to discuss 3 reasons why what we consider as contractual cash flows for this maturity ladder purpose versus actual cash flows, right? How can we get a gap there? So one thing is, it is not possible to estimate with certainty. And you can't estimate certainly the exact cash movement from all the instruments you have. So for example, some derivatives, because some derivatives, the exact point of realization is not certain, because sometimes you may exercise some rights connected to the derivatives at different points, right? So it cannot be predicted much earlier because the decisions may be taken then and there depending on the circumstances. So therefore, it is not practical to predict it much earlier. That is one thing. And then even if you properly estimate some cash flows based on the contractual obligation, let's say you look at the loan agreements and then you expect the receipt of cash based on the contractual dates with the customers. However, if there's a credit risk, that means the customer doesn't pay on time, you may actually not get that cash into the business. So it has a problem. Then there are certain instruments that you have a particular maturity date, especially investments probably, but the organization may not keep those investments until the maturity. Instead, they might realize it earlier. So then the cash flow status can change accordingly. Right? That can happen. Right. Asset liquidity. So asset liquidity means when you have assets, how you convert the asset into cash. Either it could be due to cash obtained from your asset that is divested, right? Or you can convert some of the assets into cash through repurchase agreement. You know what repurchase agreements are, right? Assets sold under repurchase agreements, if you have investment in treasury bills, without realizing it, without realizing the treasury bill itself, you can keep that treasury bill as a collateral and you can borrow. So we have what we call repurchase. That means you sell it with the agreement to repurchase. So there what you do is you sell it and collect some cash from another party, then you settle that cash back and get the security back. So actually, if you take, there is no actual sale here. It's just a contractual arrangement. You temporarily sell it and then later buy it. So it's so effectively it affects as a it works as a security than selling of assets. So that way, although you don't keep the asset until the maturity, you collect cash from that asset. Right. So there are two main factors that affects liquidity risk. Right. Sorry, I got a disturbance. So there are two main factors. One, potential marketability. That means how easily they can be sold for cash. So the ability to sell that in the market. So we discussed that under market risk, right? Whether you have a price. Then the second factor is when you use them as a collateral and try to get funds, whether the same asset can be used as a collateral, how easily you can use it as a collateral so that you can get some cash keeping it as a collateral. So those two things will determine how easily you can get the cash realized. So taking that into account, asset liquidity risk can be defined as the likelihood of being unable to transform assets into cash within the preferred time period without incurring losses. So this is what we have learned before, I think, if you can recall, right? You're unable to transform asset into cash when you need, within preferred time, right? Within the time that you need to do this, and without incurring a loss. That means at the market rate was the right price. So if you are unable to do that, that is asset liquidity risk. So then it is connected to the credit risk and market risk as well, as you can see. Then there's another thing, the funding liquidity risk. So we discussed asset liquidity risk from the asset side. Then if you look at in a financial services industry, you also need to make sure that you source adequate funds to the organization. You need to bring in cash to the organization through various means, short-term and long-term means. So there are various channels you use it. Right? You get through deposits and sometimes borrowings, various markets. So funding liquidity risk means you're unable, that means you're not being able to get those funds through those sources, right? You are unable to obtain the funds through different sources of the organizations. So that risk, that risk is called funding liquidity risk. So how do you analyze the funding liquidity? Right? Liquidity gap analysis and stress testing. Liquidity gap analysis and stress testing. And expected future funding required. So liquidity gap analysis. So before you do this liquidity gap analysis, there's a technique called cash matching. This cash matching technique will help you to identify the firm's requirements for funding. Right? What is the requirement? So how much net cash is required for future, and then that will show you the requirement of funds. So when you do that, what you do is you have to identify the due dates of some funding requirements, and then you match it with available sources, and then identify there's a requirement for an outflow. And this has to be done either way, right? Requirement to outflow and the possible coming in as well. So when then you do the gap analysis and see whether for each requirement in the future, whether there is a gap or not, right? So there's a gap or not. So you can see similar to a maturity ladder. So you look at cash inflows and outflows, and I can see in the fourth one, there's a gap of 10. So you need to address it. That you need to, because you are doing it as a futuristic exercise into the future, you need to see how you can address it by having some plans to have the required liquidity by the time you require it. Right. Now the problem with this exercise is you can see the numbers, you can see the gaps, but it doesn't consider the credit risk. What does it mean? That means when you do this exercise, you don't believe that there will be a gap. That means on the other side, you believe that the cash will come on time. But there can be situations where the cash won't come, because if there's a credit risk, the cash won't come. So then you are underestimating the cash inflows, because if it doesn't come, your actual gap will be different to what you have recorded here. Right? And also this method, it's difficult to handle option. I told you option is a derivative. What happens with options is there is no particular time period you can act. So it's an option given to you. You have a choice whether to exercise it or not. So that actual exercising of the option will depend on the circumstances. You can't predict it in advance. So only you can make an assumption, but it might be wrong. That's a problem with this analysis. I mean, those are challenges, I would say. Right. Right. Stress testing. So we've discussed what stress testing is. That is where you change some parameters. Right? You change some parameters and see what will happen, what will be the outcome. So what you do here is that you first put the cash movements based on contractual obligations or contractual liquidity data for both sides. And then, although you take it based on the contractual data, in reality, you know certain things are different. So then what you do is you adjust to the normal behavior with those modifications. And then you can see what, for example, you contractually are supposed to get certain fundings on time for the loan balances, and you know historically around maximum around 80% of the planned funds will come, others generally get late. So you know that, then you can factor that in, and then you discount 20% from the cash inflows and take it a realistic figure. So then you can see if that happens, whether you have a gap. Right. Again, the same way, when you look at the future funding requirements, you follow the same thing. You get the historical patterns, and then you place the requirements in the document. And then you look at certain statistical analysis if you want, based on the historical movement and the predictions and the market behaviors. You can have some statistical models that will give you possible movements in the cash flows in certain areas, especially the loan balances. You can bring that into the picture. And you can also do some business projection based on your strategic plan or various other management intentions, how you want to grow the business or otherwise, so that impact can be incorporated. And you can also look at, especially for large customers, you can have a ticket size or a cutoff to filter the large customers. So above the cutoff, you take customer by customer analysis than taking them as a pool, because sometimes the large customers' behavior can be slightly different, and then you can probably have an individualized pattern. So then things might be a little more accurate than taking everything in the same bucket. Right, that's the idea. So let's do one more area, that is key measures of asset liquidity risk. What are the key measures? There are 4 measures we generally consider that will define or give an idea about asset liquidity risk: bid-offer spread, market depth, immediacy, and resilience. Bid-offer spread is the price quoted by the bidder and the offer, right? The other party, the one who purchased. If the gap between the two is wide, there is a less chance of getting it materialized, right? Therefore, the risk is high. If the spread is high or wider, risk is high. Market depth, that means the level of volume that is required in the market to move prices. That means due to 2 or 3 transactions, the market prices not move. In certain markets, you need very high volume of transactions to move the market up and down. So then when there's a deep market, then you need high volume to move. So that means when there is a high volume requirement, the prices will not move fast. Immediacy, that is how fast a transaction can happen in a marketplace. That depends on the players and buyers in the market. If you have market makers, those who drive the markets, if you have enough then the market or the transaction will take place faster. So that is a positive thing for the liquidity. Resilience is when there's a shock in the market, when there is a gap in the market, the prices can move out of the equilibrium, and how fast it bounces back to the equilibrium is what we look at in the resilience. Right. That's what the idea is. So, as I told you, I need to stop the class a little early. That's why I even reduce the break also. So I will stop at this and we can continue the rest the next day and then move on. Any question, clarification on what we discussed today up to now? Any questions? Right. No questions? Good. Let's then stop the class at this, and I will continue from where I stopped the next week. Right. Good night.
Good night, sir.